The past quarter was very turbulent for income funds and bond markets alike, but still finishing strong as at the end of June. The Fed paused rates for now, but while warning of more rate hikes to come before the end of the year, and it appears now as if rates may stay high for longer. Where will the SARB go on rates, keeping monetary stability in mind? And what does this all mean for income funds, and what can clients expect going forward? Good morning to our audience and welcome back to Boutiques on Wednesdays. Always great to have you all with us, even on this cold Wednesday morning. It is my absolute pleasure to welcome back one of the top fixed income managers in South Africa with multiple awards, Philip Bradford, Head of Investments and Portfolio Management at PortfolioMetrix. Good morning, Philip. Really great to have you again with us this morning to share insights on how you see the world and how this plays out in the PortfolioMetrix BCI Dynamic Income Fund and your bond fund.
Morning, Eugene, and thanks for inviting me. Yeah, it's markets always exciting, and luckily, excitement in markets is where the opportunities are created. I don't think you would need me if markets were easy and we only had simple times.
We most definitely need you.
This morning, what I'm going to do is actually something I did 4 years ago, almost to the day at one of your BCI presentations. I spoke about betting odds and how similar betting odds and betting markets are to financial markets, and where we can take lessons from that. So you can see my slides, I assume, Eugene? Okay, great. Just double checking. So yeah, I'm going to be talking about it in the context of bond and income fund investing, which intersect quite a lot. You know, we manage a bond fund, but our dynamic income fund is probably the one you're the most familiar with. Our bond fund, we won the Raging Bull for a couple of months ago. But really, the opportunity set within this fixed income space is teed up very, very nicely at the moment. And the analogy is quite similar to me as we go into the Rugby World Cup again 4 years later, because this is where we were 4 years ago. For those of you who can't remember 4 years ago, this was a fantastic time. Remember this, like out of the blue, we really weren't expecting to win the Rugby World Cup, and it created a fantastic opportunity. Here's just a quick little flashback. Cheslin Colby getting around old Owen Farrell using his arms for the first time. And this really brings back fantastic memories. And if you have a look in the middle here, here's Ramaphoria. It's probably the last time we saw it 4 years ago. Interestingly, this was a year after the start of the original Ramaphoria, which obviously petered out. And from this point onwards, sadly enough, things actually weren't great. But this was a fantastic image. And here's something we would rather forget from the World Cup. But what most people forget was how badly the Springboks were doing leading up to that Rugby World Cup. If you go to 2016 and 2017, 2016 we lost 7 games. We lost to Argentina, we lost to Italy, we lost to Wales, and really the South Africans, we were probably at the darkest time ever for the Springboks. And then as we went into 2017, we had our biggest loss ever to New Zealand, and really things got worse. We lost badly to Ireland and to Wales twice, and that was the end of Alistair Coetzee as the coach, and then in came Rassie. And we only, it's a bit like being an investor, we only really remember the good times, and it's quite hard sometimes to remember how bad things were. Now, what's quite interesting though is if you went and looked at the betting odds 2 years out from the Rugby World Cup in 2017, the Springboks actually were serious outsiders. The chance of us winning the Rugby World Cup was very, very low. The betting odds basically only gave us a chance of 18 to 1. So you would have got odds of 18 to 1 2 years out of the rugby, 2 and a bit years out of the Rugby World Cup if you had bet on the Springboks. What that actually means statistically is that they only gave us a 5% chance of winning the Rugby World Cup, which put us in line with Wales and France, who were really struggling at the time, and only Scotland really had worse odds if we look at the major tier nations. But that also meant you had an 1,800% upside, but of course 100% downside. Now, there's a reason for that though, and it's a bit like financial markets, that when the outlook for something is bad, the odds tend to be offered are quite a lot better. And for someone like the All Blacks, as an example, we're almost given even odds. All Blacks were basically like cash giving you 0%. It was really almost no upside, but very little downside as well. But obviously that wouldn't have worked out for you if you'd bet on the All Blacks. Now, if we go back to that scenario now, well, that's fantastic. If you'd bet on the Springboks, if you'd been smart and brave enough to bet on them when the outlook was bad, you would have made a huge profit. Importantly, though, as investors, well, what can we take from this? Well, was it a safe bet? Well, actually, at the time, it wasn't really. But as an investor, we need to understand the odds as much as we do need to understand the outcome. And I'll unpack that again in a moment. Now, importantly, if we roll this forward to this year, now, you all just worked out you could have made some big money on the Springboks 2.5 years ago. Well, what do the odds look like now? And if we look at the odds as they're lining up, and this was a month or so ago, going into the World Cup, you can see the odds are France and the All Blacks are the serious favorites here. The Ireland and the Springboks then sort of close behind that, but still 4.5 to 1 on the Springboks. Then England and the Wallabies, then Scotland and Wales. You know, and if I said to you, listen, I'm going to give you R1 million to bet now, you can keep this R1 million. So how are you going to bet on the Rugby World Cup? So you're basically going to keep, regardless of whether you win or lose. Your first step should obviously be, well, I don't want to lose my R1 million. So how am I going to diversify across these different bets? Now, what you'll notice, what's quite similar, if you look at the betting odds, it's quite similar to an efficient frontier in the financial markets, in that your lowest risk sort of bet also offers you the lowest kind of return, and your highest risk offers you the highest return. And the lowest risk really means the most certain outcome, and the highest risk means the most unlikely outcome. And that's similar to equities, where cash is similar to the All Blacks in France at this stage. Now, importantly, you would diversify. But the other thing, though, is that the Springboks are not offering fantastic odds at the moment. They're only offering 4.5 to 1, where, you know, 2.5 years ago, as I showed you, they were offering 18 to 1. So there's nothing that sticks out here. So first and foremost, you want to diversify, because there's nothing really that's offering you a fantastic upside versus downside. Now, if I change these odds, though, if I move the Springboks out here to 20 to 1, also 20 to 1 odds, but with a higher probability of success, first of all, you don't get this in betting markets. It doesn't, you know, these things are very efficient. You can't wake up in the morning and get the odds in Australia and the odds in New Zealand and then the odds in South Africa and find one better than other. They're very efficient markets, like typically financial markets, and someone will take advantage of that and hedge that out and take advantage of that bet. But if the Springboks were now offering you 20 to 1, it means that, first of all, the outlying riskier bets like Scotland and Wales are actually offering similar odds to the Springboks, but with a far lower chance of winning. And the All Blacks in France, which are the favorites, are probably a better chance of winning, but they're offering much worse odds. So as an investor, what you would normally be wanting to do is say, well, I'll take some out of the cash type investments, and I'll take some out of my riskier investments, and I'll be skewing it towards something like the Springboks at 20 to 1, because there's a great upside and a limited downside. And this is actually very similar to what bonds are offering in South Africa at the moment. They traditionally have a very much higher probability outcome, safer investment, but they're actually offering odds that are similar to what you're getting out of the equity market, or the types of upside that you would expect from the equity market, but with a much, much higher degree of certainty, which you don't get in the betting markets, but for some reason or other, we're getting it in the financial markets. Now, in betting, of course, as well, you can actually bet on your team losing and still make money. For those of you who played Super Brew, or you know, those kind of betting games on soccer or rugby and the likes, you'll know that most of the betting happens on the spread of the points, not so much whether you're going to win or not. So the odds start factoring in whether someone's going to win or not. So if we give an example here, the Boks are playing the Scotland on the 10th of September. This is our opening game of the Rugby World Cup. It's a very important game, because if the Springboks don't beat Scotland, we might not go through our pool, and I've got tickets for the quarterfinals. And if the Springboks aren't in the quarterfinals and I've gone all the way to Paris, I'm going to be very, very upset. Importantly, if you look at the spreads, the odds that have been offered at the moment, the Springboks are the favorites at 1.25 to 1 in this game versus Scotland at 4.45 to 1. And the markets, the betting markets are are factoring in that the Springboks will win by 10 points or more, and that Scotland will lose by 10 points or less. Now, what this actually means is that you can bet on Scotland. You can bet on Scotland. If they lose, you can still make money. In other words, as long as they lose by 10 points or less. Now, if we took that same kind of analogy and with the Springboks in Scotland, and we flipped it around. Now, what if we made it now that the Springboks are the outsiders to win, and the odds are in their favor, but we as investors, let's say, or bettors on the Springboks go, wow, no ways. We definitely think Scotland, as Springboks are going to beat Scotland. This would be an ideal bet, because now you can bet on the Springboks losing and still make money. So in other words, you can bet on the Springboks as long as they don't lose by too much, you can still make money. And that's the ideal situation. And this is where what we can take a learning from these betting markets here. So if we're going to bet on the Springboks here, it's very similar to financial markets. So we've got to work out who's going to win. So if we're looking at bonds, equities, and other asset classes at the moment, we first got to do our work. We've got to say, let's say for bonds, we've got to understand inflation. We've got to understand the economic outlook from a South African perspective, the fiscal outlook. We've got to look at the US. We've got to look all over the world. And we've got to understand, well, first of all, is it safe to invest in equities and bonds and all these different other asset classes? So we've got to make an understanding and make a call on who's going to win. But then secondly, and far more importantly, as far as I'm concerned, is understand the odds. Because it's all very well investing into something, but we all know if you buy into something when it's overpriced, then you're going to probably lose money. But you can actually buy often into let's call it a bad investment, or something that's not likely to do well. But if you get the odds right, if you get the price right, you can still make money. And if we can find something that's likely to do well, to win, and the odds are priced correctly, then we've got a fantastic deal. So the kind of the terminology we use in investments are things like margin of safety or risk premium. Risk premium is something, particularly in asset allocation. We talk about an equity risk premium or a bond risk premium. In other words, are we getting an extra premium or an extra return given the risks we're taking? And if we can find a lower risk investment with a high risk premium, then now we're talking. And an ideal bet is, or an ideal investment is one when you get your investment call wrong, but you still make money. Now, how does this apply? Well, South African bonds have actually been on a losing team for the last decade and more. And if you take from 2013 onwards in particular, just as a decade ago, that was the start of the taper tantrum. It was the start of, remember the debt crisis in Europe. We were talking about pigs and all the likes as well. The rand blew out. We had a big blowout on bonds and inflation-linked bonds, and the currency in South Africa weakened a lot. We actually started managing money in this space 8 years ago in July 2015. And almost from the start, when we started managing, particularly the income fund space, we had things go badly. We had Nenegate. We then had this period of Ramaphoria where things tailed back. And by the way, the black line here is the rand, and the blue is the all bond index yield. So when the yield's going up, obviously the bond prices are going down. And then from then onwards, after Ramaphoria, we had state capture. And then we actually had, this is when the Rugby World Cup was 4 years ago. And since the Rugby World Cup, and why this is relevant is because 4 years ago, I stood here in front of all of you and I said, bonds are really well priced. I couldn't use the Springboks at the time as the analogy because everyone would have thought I was crazy. But I said, imagine getting the All Blacks at 11-1. It's a good deal. They're probably going to win. And the odds, if you could get them at really good odds, it would be a no-brainer. And obviously the All Blacks didn't win. And it became a terrible environment for bonds. We had COVID. We had the biggest sell-off effectively in 25 years in our bonds. We then had this recovery. But then last year we had the Ukraine invasion, which was then followed by the inflation crisis. It was followed by the Fed and the rest of the world hiking interest rates aggressively. We then had the UK doing their own Nenegate with Liz Truss firing the finance, or bringing in the finance minister and messing around with their fiscal situation. We then had Pala. We kind of knew from 5 years ago that we were going to have problems going into the ANC elective conference, and the ANC didn't let us down. Then we had the energy crisis with load shedding as we've gone into this year. And then more recently in May, in the back of the energy crisis, the Lady Russia Gate, which pushed the rand to all-time lows. So actually, based on what I said 4 years ago, surely we would have done really badly. Well, the irony was, if we apply the Rusty sort of methodology and we look what's actually happened, this is what all the different asset classes have done. Local equities and bonds have done okay, but not fantastically well. If anything, they were relatively muted returns for SA equities. Cash, property did badly. Global equities did really well in Rand terms because the Rand was depreciating and equities have been upwards. But everything else wasn't great. Even the Rand-dollar exchange rates actually didn't give you that much of a return. It gave you worse return than cash. And with the interest rates on dollars, it gave you a sort of a similar return to bonds and equities. But really, if we look at the return of our portfolio over that time, we were saying, listen, bonds are positive, but the odds are in your favor. Because the odds are in our favor, we actually managed to, the only asset class that managed to outperform us, sadly enough, was global equities in rands. All the other asset classes available to you, even global bonds and global cash, didn't outperform something that was priced well. And if we look at it on a scatter plot basis, which is more similar to what we were looking at in the betting odds, you'll see here that this is what actually happened. Not only did we have a reasonable return, but it looks quite similar to the analogy I gave of getting the Springboks at better odds, because it's sitting above all these other investments over that period. So it came out with a higher probability, lower risk outcome, but still with decent returns. And now subsequent to that as well, by the way, because that's showing you up until the end of May, we've had an absolute disaster going sorry, that was to the end of April. Into May, and in particular, we had one of the biggest sell-offs we've ever had in our bonds. Eskom pushed us to, this is showing, by the way, load shedding and how highly correlated it was with the Rand-dollar exchange rate. So in other words, when we got to the highest levels of load shedding a month or two ago, as we went up in load shedding, the Rand was weakening. As load shedding looked like it was going to be better, the Rand tended to be strengthening. And we can blame almost all of the Rand weakness on the load shedding, except for our little relationship with Russia, which caused even further problems, as really the financial markets were factoring in the worst case scenario. They were factoring in grid shutdown, and they were factoring getting us chucked out of the AGOA deal and the Rand tanking on the back of that. And what this resulted in was the fourth worst sell-off in bonds we've had in 25 years. I mean, we're comparing it with COVID, Nenegate, the dot-com bubble. Taper tantrum was actually not as bad, and the EU debt crisis wasn't as bad as May was. And what's great about this, though, is we were able to buy into a lot of that weakness and actually take advantage of that for investors. And we've seen a very strong recovery since then. And interestingly now, if we have a look at this, if we look over the last 1 year, 3 years, 5 years, 7 years, and since inception with the strategies we've been managing, you've achieved over 9% per year in over all of those periods. And that's an environment where we've done badly. So the environment for bonds has been bad, but you've still been able to get a decent return, which of course means in a better environment, you would actually see an even better return than that. And that's the nature of bonds as an asset class, is that they're like a fruit tree, like I often like to say. That it's the fruit you're going to get at the end of the day, and the capital volatility actually comes out in the wash over a period of time. And if we compare this to our other funds as well, as I mentioned, we won the award for our bond fund here, but the dynamic strategy sits somewhere in between the bonds and your typical income type credit instruments. And the combination of the two has actually resulted in about 2.5% outperformance per year of the peers, and ahead not only of that, of the peers. This is the combined track record since inception now, ahead of any of the other peers in the multi-asset income space, but importantly also outperform bonds, because this is the next thing I'm going to, is that bonds from this point in time are teed up to do really, really nicely for investors if we start moving into a lower interest rate environment globally. And we think we're really nicely positioned to potentially even continue to outperform a lot of the bond funds because of the way we positioned as well. We've done it consistently over a long period of time, but actually in this environment now, we've added quite a lot of bonds to the portfolio. So why have we done well in this volatile market? Well, the key thing is to be active as well. Is to wait for opportunities when interest rates on bonds are low. You want to hold less of them when bond yields get high, like they did in May. We managed at one stage to buy some bonds around 12.83% on some of the government bonds, which are the most liquid, highest credit quality assets in the country. And when we can buy those kind of assets on sale like that, really offering equity type forward returns, it becomes really a fantastic thing in a lower risk portfolio like this. So we've got our bond exposure up. This just gives you a feel of the amount of bonds we've got. And you'll notice that we've effectively almost tripled the bond exposure, the fixed rate bond exposure from what it was a year or two ago. Our exposure just the day before the Ukraine invasion was low. It was the day after the budget speech that the Ukraine was invaded. And subsequently, we've steadily been increasing the exposure into weakness and effectively just locking in very high fixed deposit yields for investors. And what you'll notice is the last time we had similar bond exposure to this was actually 5 years ago during Nenegate. So the last time we had really good bond exposure was just before the last ANC elective conference, when we increased the exposure to actually a little bit higher levels than we've got now. But now the yields are even higher, so we don't even have to hold as much. Now, and the yield is what it's all about. You know, if you want to know what is a bond or an income fund going to do, the most important factor to look at is what is the current yield. The current yield of the portfolio, this was at the end of June, was 11.8%, which is the gross yield, which is the highest we've been for a number of years. You'll notice back in February 2021, the yield was below 8%. And with the yield nearly 12%, it actually touched 12% at the end of May. That gives you a very strong indication of the forward return. So even though the portfolio has done nicely over the last 1, 2, 3, 5, 8 years, the yield of the portfolio is actually the highest it's ever been, which means the forward return outlook from a fixed income portfolio, which is essentially like a fruit tree, it's giving the highest yield that it has pretty much ever. So the forward return outlook for fixed income from here is the best it's been for many, many years. And when I talk about losing, investors winning when the markets lose, here's a good example of that. You know, we focus a lot on the downside, and we focus a lot on 12-month returns. What we don't want, we've got a lot of investors that are not only asset allocation investors, but are investors that are looking for income, or corporate investors that are cash and longer type investors. And what we found, if we stress test and show the portfolio during these disastrous times that we've had over the last 8 years, if you had invested just before Nenegate, if in other words your timing was terrible, the day before Zuma fired Nene and brought in the sort of weekend special finance minister, 12 months later you would have been up just under 9%. If you had invested just before COVID, 12 months later you would have been up just under 8%. And if you had invested just before that Ukraine crisis now, you would have been up 9% to the end of June. So what's important for us is those are the bad scenarios. So if we look forward from here, off a yield of over 11%, we know that a bad return would be 8 or 9%. A disastrous return is probably something similar to cash, or a 6% return would be a really bad return, given how high the yield is at the moment. And the upside return from that could obviously be a lot better than the yield of the fund itself. So what's the fixed income outlook? Well, importantly, inflation is seemingly returning to what we would call normal. And I've shown this here on purpose because normal was really from the 90s onwards. Once inflation targeting started coming into play, there's been a lot of talk over this last year referring to high oil prices in the 70s and the 80s, and maybe we're going back to that area. But the factors that drove inflation to those levels are not prevalent at the moment. Eugene mentioned at the start that there's risks of global economy slowing down. There's risks around. We've got poor demographics that are going on in the global environment, and that's kept interest rates at a much lower level than they were in the 70s and the 80s. And you can see we had this big spike in inflation in the last year or so, but it is starting to come down again. We just don't know how quickly it will come down. But we do have an indication if we look at the central banks, particularly emerging markets. South Africa, we were quite lucky because our inflation didn't spike as much as other emerging markets like Brazil. but our inflation is, because of load shedding, has stayed a bit higher than it was expected to, and that's the main reason really that's been causing the problems with the rand if we compare it to other emerging markets year to date, which I'll show you in a moment. But you'll see that emerging markets really got ahead of the curve and have actually been they're in a better position to potentially start cutting interest rates if the developed markets start cutting interest rates. So emerging markets are quite well positioned. They got ahead of the curve. They raised interest rates earlier, and we're watching quite closely to see, hopefully, when we can start seeing rates coming down in over the next year or so. Importantly, the Fed and the financial markets, the bond markets, are actually agreeing for once. And you can see between the purple line and the blue line here that the outlook is still for interest rates to go up a little bit more, but the outlook for interest rates to be lower over the next couple of years. And the Fed sees the longer term interest rate back down at 2.5. So whilst the risk is that interest rates stay a bit higher for longer and hurt growth, the outlook definitely is for interest rates to top out and to start moving downwards, which is typically a very good time for bonds. The South Africa's underperformed other emerging markets year to date because of the load shedding and the sustained inflationary pressures we've had, unfortunately. And you can see how it's underperformed the likes of Mexico and Brazil year to date from a currency perspective. So not only have we done badly against the dollar, we've done badly when the other currencies like Brazil, which is normally our closest peer, has actually done well against the dollar. So a lot of that is stretched out a bit too far. We've seen the rand weakening again yesterday in particular, but the rand definitely has given up a lot against other emerging market currencies. And one of the main reasons for it is this, I touched on it earlier, is that the Brazil, their inflation rate was very high a year ago, and it's come down a lot to current levels, and their cash rates are still very high. So we're complaining in South Africa about interest rates being high, but Brazil's interest rate is closer to 14%. So the gap between their cash rates and their inflation rate is very high at the moment because inflation has fallen sharply and they've kept their cash rates quite high. And this makes other emerging markets like Mexico and Brazil more attractive than South Africa when you look at the difference between cash and inflation. But importantly, those South African longer term rates are quite attractive. So the gap between the black line and the gray line here, which is essentially the difference between cash and inflation, might be relatively low in South Africa at the moment. But there's an extra 4% to be had by investing in some of the longer dated bonds. So our long dated bonds, and this is the 20-year rate, just giving you as an example here, is showing a big gap compared to what we've seen historically. Historically, we tended to be a much closer. And if you look back actually to 2008, the cash rates were much higher than bond rates. I've shown this before where cash rates, if you go back to 2008, cash rates were 4% higher than bond rates, where now bond rates are 4% higher than cash rates. So there's an 8% swing difference between what they were just over about 15 years ago. So the opportunity in the bonds is looking, the pricings, that like I mentioned with the betting odds, is looking very attractive. And the market is expecting interest rates to start coming down. So not only in South Africa, but around the world, as I mentioned, and the interest rate derivative markets, the FRAs, etc., are factoring in rates being about 1% lower in a year's time. So whilst this can move and change, the outlook is still for rates to stay relatively high, maybe go up a little bit again. But the longer term outlook, and bear in mind when we're buying bonds, we're taking a longer term outlook, is for rates to be moving down from these sort of levels. And one of the reasons for this is load shedding at the depths of the energy crisis. It's not over yet, but as I showed you, that when load shedding was at its worst, that's when the rand was at its worst, and we've seen that start to dissipate. There's a couple of reasons for it. One of them is the private sector's stepped up over the last year and a bit, and we've seen a lot of capacity come online. These stats showing at the end of June is that essentially privately developed power is taking away 4 stages of load shedding. And that is likely to increase going forward, because one of the things we were finding in May, that the market was being too negative, and the probability of a grid failure was actually much lower than the market was expecting. And the likelihood, as long as we got through winter, that once some of the power stations start coming back online towards the end of this year, And once a lot of the private power comes online, the risk of load shedding getting worse was going to start falling away. And this is exactly what's playing out. This is just from Project Vulindlela, which is the presidency's project working together with the private sector. They're forecasting that there's about 8 stages of load shedding of power coming into the system, which is essentially means that can buffer away at least 8 stages of load shedding over the next couple of years. So the risks of getting to those really bad stages of load shedding are falling away a bit over the next few years. We're not out of the woods, but it's definitely looking a little bit better. Now, importantly, you buy bonds normally when rates start going down. That's simply, it isn't always perfect, but really at the end of the day, when rates are about to be cut, you want to start fixing your interest rates at nice high levels. And this is just showing that typically, if you start buying bonds before the rate cuts start happening, it's normally fine. And then once the rate cuts start happening, you tend to make some decent capital gains. It isn't rocket science. At the end of the day, if you can lock in yields around 11 or 12% and interest rates are starting to go down, that's generally a good idea. And that's exactly what we've been doing. And bonds are currently sitting around at 11 to 12% level. And historically, if you've bought the all bond index around 11 or 12%, your average return has been somewhere between 16 to 17% per year over the next 2 years. Now, there's not a lot of times we've been here. We've almost never really been at these levels. Your longer dated bonds have actually never been traded out at these levels, because the last time interest rates were very, very high in the late 90s, we didn't really have very long bonds. So you didn't get to a lot of these levels. But it really, at the end of the day, when yields are nice and high, it creates a great opportunity for investors. Whether you're a low risk or a high risk investor, those kinds of returns are very attractive. So we've added a lot more of those bonds to the portfolio. So with a current yield of, and that's a gross yield of around 11.8% at the end of June. It's a little bit lower today, but around between 11.7, 11.8. That's your best indication of the forward return. We've got 47% of the portfolio currently at fixed rate bonds. We were at 18% just over a year ago. So when interest rates got better, we've added more fixed rate bonds to the portfolio. It adds a little bit more volatility to the portfolio. But what a lot of investors don't realize is that the fixed rate government bonds in particular are the highest credit quality, most liquid assets in the country. So while they come with a bit of capital volatility, they are actually much, much more liquid. And from a credit perspective, actually much safer investments than corporate bonds and a lot of those other assets, which the value of the price doesn't move around as much, but the credit risk and the liquidity risk is much, much higher. So the yield of the portfolios now is higher than the all bond index for the first time in many, many years. But of course, with much, much lower duration and interest rate sensitivity than the all bond index as well. So we positioned actually the highest yield we've had for many years, which is the best indicator of the forward return. And what this really means is, despite bonds having been on this losing team, as I used in the gambling analogy or the sports betting analogy, the investors have still managed to win. The spread, like the betting spread, if you're playing Super Brew on South African bonds at the moment, is very, very attractive. It's actually bonds are offering you the kind of return going forward that you would hope to get from riskier investments like the stock market, but with much better downside characteristics. So the probability of them doing well is much higher, and the probability of you losing money is much lower. So if you can, the best performing stock markets in the world over time have typically given you about a 10% return. The best performing stock market over the last 130 years has been South Africa, and that's given you just over inflation plus 6, and bonds are currently yielding over inflation plus 6 at the moment. So they're priced to give you an equity type return. There's always risks, and that's why we have diversification as well. But if you're going to skew your portfolio in one direction, it should probably be more to bonds at the moment. In a falling interest rates environment, it tends to be positive for bonds, and off yields at these sort of levels, it just makes an attractive investment. Importantly, though, there are risks out there, and today we've seen overnight that Fitch has downgraded the US from AAA to AA plus. These are the kinds of risks that can throw things into turmoil as well. Most of the sell-offs on SA bonds and the Rand tend to come from global events. So the biggest risk to South Africa at the moment is probably more a global growth slowdown. But in that environment, you're probably going to see central banks start cutting interest rates again as well. So it is an environment that is probably leading to lower interest rates rather than higher. And we think we're very well positioned from that. And just to show you, since inception, if we go back to 2015 of our track record, the total return of over 100% has actually, interestingly, been it's about 2.4% ahead of the peers, but way ahead of equity, sadly enough, way ahead of actually even your multi-asset high equity category. So one of the best investments you could have made over the last 8 years, last 4 years, the last 5 years, etc., has actually been a more conservative investment, and it's teed up, interestingly enough, at higher yields than it was 5, 6, 7, 8 years ago. So actually, the bonds are priced better than they were than the return they've given over this last while. And again, significant outperformance of the peers in this space, 34% outperformance of the peer average, and significantly ahead even of the bond market as well over that period. So we're looking to take advantage of both of those, and the outlook is better. Your best protection against bonds in South Africa is probably your offshore investments. So your offshore equities and those other asset classes tend to do well when the environment for SA bonds is bad. And that's really where your best diversification will come if things go worse from a South African perspective. Eugene, if that's the end of my presentation, I'm happy to take questions if anyone's got some.
Yeah, Philip, thank you very much for that. Very insightful indeed. If we can maybe just look at your dynamic income versus your bond fund. And I mean, if we look at almost a year ago, June 2022, bond yields also extremely attractive. Some of us bought peer bond funds, played out to be, too early in the cycle. You also mentioned your dynamic income fund. Your yields are currently higher than they'll be. So my question would be, when would investors look at using your dynamic fund, and when would they move to your bond fund, or do they just stick to the dynamic income fund and let you manage it?
Yeah, it's a good question. So what we're doing so if we had a strong rally in bonds, like if bonds rallied 100 or 200 basis points in yields from here, on a straight foot race, the bonds should come past us and should do better. The challenge, though, is that's if things go in a straight line. And what we tend to find is we tend to have 2 or 3, last year 5 or 6 sell-offs in a year that creates opportunities. And what we've done is if we're buying in the ALBI, if the ALBIs or the All Bond Index is our benchmark, you're holding a lot more fixed rate bonds. Obviously pretty much 100% almost in fixed rate bonds. So you don't really, if there is a sell-off, you're going to sell off as much as the All Bond Index. So what we do in something like dynamic income is we'll hold a lot more of bank type credit bonds or bonds that aren't as volatile, floating rate bonds, credit linked notes, other instruments that don't sell off when you see a bond sell off. And then what's quite powerful about that is it allows us to then invest into fixed rate bonds when, take advantage of the sell-offs. Where if you're invested in the All Bond Index only, if you've got the view that bond markets are going to run in a straight line from here, then it will do better. We've got quite a lot of most of our investors are professional investors, are multi-managers, and quite a few of them actually hold now both. So some use us as a sort of an allocator within the fixed income space. So we do the asset allocation for them between what we would call income and bonds. And some of them have said, listen, well, in their asset allocation, they want to go overweight bonds. So then they add our bond fund to that as well. So it's really a case of, it's good old risk profiling. It depends what your risk profile is. And we're obviously going to manage that risk as much as possible. Our objective in dynamic income is to provide a similar return to the All Bond Index, but with much lower volatility, where our bond fund is trying to do the All Bond Index plus sort of 1 or 2%, hopefully over a period of time. But we know that if there's a sell-off in bonds, you're obviously going to have more capital volatility in the bond fund. But both of them are, the All Bond Index is not a great benchmark. You've only got, it's dominated by 13 odd government bonds. Over 98% of the All Bond Index is government exposure. where what that means is it ignores all the bank bonds, all the insurance company bonds, some of the other we don't go invest in other corporate credit like normal normal corporates, because we find that much riskier from a credit risk perspective. But you miss out on a lot of those opportunities. So there's over 2,000 instruments listed on the bond exchange in South Africa on the JSE, but the All Bond Index only has 20 bonds in it, and it's dominated by 13 government bonds. So it's really about looking for a wider opportunity set, and we find for investors that are slightly more risk averse and don't want to just take that, don't have a very long-term view, then the dynamic income suits them much better.
That makes a lot of sense. Let's just talk about ILBs quickly. I mean, it's something that keeps on coming up more and more frequently. ILBs seems to be very cheap at the moment, but the views out there on ILBs are so diverse. Some are totally in love with ILBs, where other managers are just going, it's a total no-go. What's your views on ILBs as part of a client's fixed income component? And does that fit into your dynamic income fund world?
It's all about price and yield that you're going to get. And the challenge we've got in South Africa, the inflation linkers are structurally overvalued relative to the fixed rate, nominal fixed rate bonds. You've got a big demand from your life companies, your insurers, all the actuaries out there in their asset liability portfolios, the pension funds that run those asset liability kind of matching portfolios. They go and buy inflation linkers. There's not as much supply of them, and the demand pushes the yield lower than it would in others. So what we find, I mean, if we literally take we talk about the inflation break evens. In other words, what is the inflation rate that the inflation has to be to make inflation linkers give you the same return as nominal bonds? And we've found over many years now that it's just inflation is unlikely to be high enough. And probably your best example was last year. We had this massive spike, unexpected spike in inflation, and the inflation bonds still underperformed fixed rate bonds. So it's really a function of price again. It's always about, like I said, like inflation link. You can say, oh, inflation is going to go up, but if fixed rate bonds are pricing in more inflation than is actually likely to happen, then you get a better return. The other thing as well is inflation linkers have much more duration. So if there's a sell-off, I'm talking the longer dated ones, you get hurt a lot more. So I think the market doesn't understand inflation linkers as much. It's a much more complex instrument. It doesn't mean you're just going to get inflation plus a yield. It's far more complex than that. And we just generally just find they're not as well priced as the fixed rate bonds. And what we've also found is they tend to bite you exactly when you're thinking what. And by the way, an example of that was in the middle of the crisis last year globally, the one investment that had done almost the worst was global inflation-linked bonds when inflation was at these crazy high levels. Because if you overpaid for them, you lost money.
Yeah, sticking to inflation speaks to one of the questions from the client, from the audience as well. What do you think are the top 3 issues that could keep global inflation higher than the market expects?
Yeah, inflation's a function of supply and demand. I always think of inflation as a rope. You need for it to be tight. For inflation to be tight, you need someone pulling on both sides. So the inflation when it went up in 2021 in particular was on the back, or in 2022 was on the back of supply issues that were causing a tightness on the one side, and then as demand caught up with that, we had a tight inflation. It's one of the reasons South Africa's inflation never really got that high. We had supply problems, but then we didn't have the demand problems. And if you look at our load shedding problem, it's actually a supply problem. It's influencing it's not a demand driven problem that's causing inflation to go up. So the key thing that's actually keeping inflation higher is that growth is actually staying higher for longer. But that eventually starts running out of road. And if they keep interest rates too high for too long, it's likely to kill off growth. And that actually, ironically, is more of the biggest risk, I think, for South Africa, because in a slower growth environment, that's generally not good for emerging markets, emerging market currencies. It would hurt our revenue from a commodity perspective, so it would hurt our tax revenue. So actually, the bigger risk, I think, is that growth slowing down rather than, for South Africa anyway, and our bonds, rather than inflation staying higher. So So for inflation to stay higher, inflation can be high for good reasons. If growth is good and inflation is higher, that's the demand pull side. That's not a bad reason for inflation going up. But that is almost what's happening in the US in particular at the moment, is the market's staying stubbornly on higher growth better than expected, and it's causing them to keep rates higher for longer. But as we're seeing, as energy prices in particular are slowing down, a lot of the heat is coming out of inflation. So really, at the end of the day, inflation is a growth rate, and it can't carry on shooting up at 10% forever, because it eventually kills off growth as well.
But just on global bonds very quickly, I've seen some calculations done by some analyst companies. If you look at US bond yields at the moment, also very attractive. And if they were to cut rates by 2%, global bonds can, or US bonds can give you anything between 15 and 18%, provided that those numbers that I saw are correct. Your views on global bonds, would you ever include that in something like the dynamic income fund?
Yeah, so we're very explicit about avoiding property, equity, and taking on currency risk within the portfolio, because that can, here we're trying to make like 1% a month, and you can lose 5% on the currency in a minute. So you've got to be very, and also when you go into a US Treasury giving you 4%, I'm giving up 12% in South Africa. So I need, over 12 months, I need the rand to appreciate by 8% just to break even. So I think what we can do is buy foreign instruments and hedge them out. In other words, you bring the yield back to rands, but then you're actually doing something very similar to buying a local instrument. So we're not going to go and buy hard currency instruments. In our multi-asset portfolios, we might hold those, like we hold global equities. And those, the rand blowing out is your best protection against things going wrong in South Africa. So you want to benefit from that. But I definitely think, yeah, those global bonds, I mean, we've had like a US downgrade overnight. We're still trying to digest exactly what that means. The market hasn't reacted much. But at the end of the day, 4% yield is a lot higher than naught, where it was not too long ago. So I think those yields for a dollar investor are quite attractive, particularly relative to equities. But in these sort of portfolios, we steer clear of trying to get cute and hedge out currency, because you give up yield and you bring on a much higher currency risk.
Yeah, it does make a lot of sense. In terms of, or let me rather rephrase it a bit, you've illustrated over years the impact that it has, and the active movement between fixed and floating rate notes, and having to trade those positions to generate alpha for clients. Do you think that being more nimble compared to some of the larger managers has an impact on the income funds? We all know bond markets are very liquid, but does it have an impact on the income fund being more nimble and being able to move a lot quicker?
Yeah, I think so, because it was one of the reasons we stick to, when we talk at corporate bonds or corporate paper, we try and stick to the banks in particular. We want liquidity. We don't want to go into riskier credit that might maybe give you a high yield, but comes with liquidity issues. So the ability to be more nimble is important. And I think at the end of the day, other income funds are doing something different to us. So we're not trying to do, most income funds over the years have become a cash plus one kind of sort of strategy, and they don't want any capital volatility. We actually embrace the capital volatility. We know that just enough capital volatility is adding a 4% yield. And we also know that the capital volatility in the government bonds is quite short-lived. We saw it in May. Things were down a lot. In June, they came back quickly. So we're very confident that the nature of bonds, the volatility is quite short-lived. It's like turbulence on an airplane more than anything else, and that creates the opportunity. And I think what we're doing is different to what other income funds typically do, because we're trying to do that asset allocation in that fixed income space. So I think a lot of funds are focused on a specific benchmark, which is a cash plus benchmark, and then you've got bond funds focused on an all-B type benchmark. And we trying to actually do that allocation across the two of them, and that's really what's different. And for us, because we're taking like a 12-month view on things and longer, when we can buy a government bond at over 12% this morning, or you could go and buy unlisted credit, floating rate credit at a lower yield. Now, we're happy to take the fixed rate volatility. It's actually better credit quality, much more liquid. We could remove the interest rate volatility, but then we're taking much higher credit risk. So for us, it's like that doesn't make any sense, but that's our mandate. So we are trying to provide a different kind of outcome and to take advantage of the range of opportunities. You know, I showed earlier, Eugene, in 2008, you know, cash was 12 and bond yields were 8. That was a different world. Then you wanted to be in a bank credit plus 1%. Now it's the other way around. So you will need to adapt. So I think we've adapted to the way the market's adapted. You know, I grew up in the bond trading days when you had inverted yield curve. Now we've got a steep yield curve. So, you know, the whole point is to adapt to that. And you know, whether you're 18 or 80, a yield of over 11% is a decent return. So for us to not take advantage of that simply because we don't want a little bit of interest rate volatility, I think is the wrong investment decision.
And me looking at your strategy, the proof is in the numbers, and you've showed all those numbers. Philip, we are unfortunately very much out of time. I've kept it going for a little bit longer. It's very insightful indeed. Thank you for the good work you and your team does on your fund. To your audience out there, the PortfolioMetrix BCI Dynamic Income Fund is available on all the big platforms. If you need more information on the fund, please get hold of one of her BCI sales team members or Alan Getty from PortfolioMetrix that's on the line as well. Philip, once again from our side, thank you so much for joining us this morning in your time. We're really grateful for all the work you've done and the time you've set aside for us. Just a quick reminder to our audience, our next session or the next week, Wednesday, is a public holiday. So we take a bit of a break. The next session will be on the 16th of August with our top global fund managers looking at global equity. We've got a superb lineup there for you. The session will start at 11:30. If you haven't registered yet, please do so. There's a diary invite as well. It will register for 11:30. It will go on a bit longer, probably for about 3.5 hours. But we're going to cover a lot of ground on global equity, a lot of questions there. And again, to our audience, thank you for your continued support. We really appreciate it. Philip, to you and your team, Alan, thank you so much for the work you do. And we look forward in engaging with you in the very, very near future again. Thank you so much.
Thanks, Eugene. And good luck to the Springboks.
Yes. We'll see what those bets are like.
Cheers. Bye-bye.
Thanks.